Welcome back, folks. This is Basir Pirzada, your real estate broker and your mortgage loan broker, all in one-stop shop. So, like I promised you a couple of days ago, that I will come back with a detailed analysis and decoding the first meeting of Federal Reserve by the new chairman, Kevin Warsh. So today I prepared some slides, so just bear with me. So the first thing he talked about on June 17th, his first meeting, that interest rates to remain unchanged at 3.5 to 3.75%. Now, this is not what you pay for home loans. That's not your home mortgage loan interest rate, but at this funds rate of 3.5 to 3.75%, the home mortgage loans interest rate is hovering around 6.75% for borrowers with perfect credit. So that's huge. Remember when you were paying 3% or 3.48% for home mortgage loans? So it's almost doubled since COVID. So inflation, Kevin Warsh talked about, the inflation has been above 2% for the past 5 years. So now they're openly admitting that their goal of getting 2% inflation rate is pretty much gone. It's totally destroyed by the ongoing inflation. So, but in his overall press conference, he did not give any forward guidance statements. If you remember, the previous Federal Reserve Chairman Jerome Powell would always make forward guidance statements like, this is what we're expecting in the next few months and blah, blah, blah. And that would consider forward guidance, and it would kind of morally or indirectly or implicitly control the financial markets. Let's look at a dot chart that the Federal Reserve meeting always releases. Okay, so looking at the dot chart, you can see that there's a total of 18 Fed members, and the Fed chairman being the 19th one. And all these members put dots on what they predict to be their projections, their personal projections of interest rates, hikes or drops in the coming months and years. So a total of 18 Fed members, with the Fed chairman being the 19th one, put their dots on there. And as you can see on the dot plot chart, there are 18 dot entries for each year, because the Fed chair, Kevin Warsh, did not submit his projections so as not to influence the opinions of the Fed members. So for 2026, you can see that maximum number of dots predict that the interest rates are going to remain the same or unchanged between 3.5 to 3.75. In 2027, the maximum number of dots indicate that it may go up by a quarter of a percentage point up to 3.75 to 4. In 2028, they're predicting to go down to 3 to 3.25. And in the longer run, they're predicting it to be at 3% Fed funds rate. So that's interesting that Fed chair did not intervene in the dot plotting, but still the consensus of the Fed members is that the rates are going to stay either unchanged or go up by the end of 2026 or early 2027. One more thing he announced in his first meeting was the task force announcements. Now, my personal opinion is that it kind of reminded me of those corporate guys who don't want to take responsibility for their actions, and so they have always someone to blame. That's my personal opinion. You may disagree with it, but let's watch a clip where he's announcing these task forces, about 5 of them.
On a key initiative that we're announcing today. I'm appointing a task force in each of 5 areas that are central to the broad conduct of monetary policy. First, Fed communications. Second, the Fed's balance sheet. Third, our use and reliance on existing data sources. Fourth, productivity and jobs in an era of transformation. And last, the Fed's inflation frameworks. These subjects are timely, consequential.
So as you saw, he announced 5 task forces, one for Fed communications, one to deal with Fed's balance sheet issues, one to deal with data sources to determine inflation rates, so a task force to find out where this data is coming that tells us that the inflation is this much or that much. Productivity and Jobs Task Force, and then a fifth task force for Fed's inflation framework. So what they are, the critics are saying that Kevin Warsh is trying to revamp and reorganize how and what data is included in the determination of the inflation rate. So the critics say that Kevin Warsh is trying to change the selection of goods. So let's say if the tomatoes are going up in price due to inflation, and cauliflower is not going so much, so Kevin Warsh and his team will go and use cauliflower as one of the products to determine the inflation rate and come back and say, you know what, we we looked at the data and the inflation is not going up because these products are not going up in prices. For example, cauliflower. Of course, they're not going to come back and tell you they were so selective in choosing what's going up in price and whatnot. But that's some of the critics are saying that he's fudging with the selection of the data behind the scenes. Kevin also talked about how AI is impacting job force and productivity, employment, jobs. So he is admitting that AI is playing a huge role in job force and productivity levels. He also mentioned that task force will determine which forces are the drivers of inflation. Is it the Iran war? Is it the housing market, etc.? One thing that was kind of significant and kind of got missed by the mainstream media is that Kevin said that he will focus more on the left of the decimal point rather than to the right of the decimal point when it comes to inflation. So what he's referring to is that inflation is always mentioned in terms of, oh, it's 2.9%, oh, it's 2.1%. He's saying that he doesn't worry about is it 2.1 or 2.9 as long as to the left of decimal there's a 2 or a 3. So the critics are saying that what he's basically indirectly saying is that you can have an inflation all the way up to 2.9% and he's not going to be bothered by it, and he's only going to worry about if it crosses 3.9% because he's only worried about the number that's to the left of the decimal point. So let's watch that clip where he shares his sentiments about that.
On the 2% inflation objective, that is the Federal Reserve's long-held objective of 2%. You've heard me say before, I tend to focus on the left of the decimal point. Well, the 2 is the left of the decimal point. For now, 0 is to the right. I see no reason until we have reestablished our commitment and ability to deliver on the 2% inflation objective to revisit that. So that'll be outside the scope of what we're taking on.
One more thing Kevin talked about is that the Fed has been using antiquated, old-fashioned, outdated survey methods of collecting data about inflation and that it needs to change to keep up with the times. Kevin said that we need real-time data and not data from 3 weeks ago. He's referring to whenever the previous Fed meetings happened and they said, well, last month, last Tuesday, we had this jobs report and based on that. So what he's referring to that is we need real-time data. So let's look at that clip where he talks about that.
I'll say this generally. Most of the data that central bankers and other government officials in the United States consume come with old-fashioned survey methods, national accounts of what the U.S. economy looks like that looks very little like the U.S. economy in 2026. Survey methods that don't have response rates that we need, asking questions that might have been quite applicable a generation ago that are less applicable now. So even inside of official statistics, I would be open-minded if the task force and our own best thinking had recommendations how those official statistics can be brought up to a standard of our time using new analytic methods. I'd also say this. Almost every private company CEO that's running his or her business are doing so with real-time information that isn't subject to much revision, that is telling them what just happened at that very moment. As you know, there are normal, long and variable lags in the conduct of monetary policy. What we're really interested in is what's happening right now. What we're less interested in is echoes of history. And you're hearing from my answer that some of the data that we receive, that we're waiting on, the first Friday after the month, the payroll index or something else. That might be an echo of history that's quite useful on its third revision. We need to take those error bounds down because we have to make hard decisions in real time. I'm really open-minded that there is a lot of new data sources that we can learn from the private sector, from reforms in the official sector, and new analytic techniques that are far more refined than asking a simple question about whether something was core or non-core.
Regarding forward guidance, he said that he wants financial markets to react to real-time financial market data rather than reacting to what the Fed chair said about it. Let's watch a clip where he talks about how he wants the real-time data dictate the actions in the market rather than the entire nation sitting down and watching what comments he has to make. So let's watch that clip.
So I think financial markets perform best when they react to incoming data. I think the financial markets work less efficiently when they ask a question, how will the Federal Reserve react to that incoming information? The more that markets are paying attention to what's happening in the real economy, deciding what's good data and what's less good data, the more financial markets can price what they believe is the most likely and what are the tail risks. Financial market prices are probably the most important source of information to guide central bankers. But when all the financial markets are doing is reflecting back what we've said, then we're taking the most important source of information and we're being blind to it. I'd like us to create a system where those blinders come off, where markets are following data that they efficiently think is reliable, and they'll be watching data, we'll be watching data, they'll come with better information through market prices to us, we can make more informed decisions, with ultimately the goal that I said at the outset, deliver on the price stability objective that Congress told us to do.
At one point in the press conference, he was asked if he could comment on the rising grocery prices of milk and eggs in the country, for example. And unlike the previous Fed chairman, Jerome Powell, where he would always have very sympathetic comments for the consumers of the American economy when it came to grocery prices, Kevin Warsh had kind of like a little cold-blooded response that we don't control the grocery prices of milk and eggs, and that's not our mandate. Our mandate is to ensure that the prices of milk and eggs do not impact the overall price levels of consumer products in the economy. So basically, all these goods going up in prices, if they trickle into a larger impact on the economy, that's what our mandate is to control, not individual, how much is milk and how much a dozen eggs and stuff. So let's watch that clip where he shares his thoughts about that.
Chapter of the Fed.
If I told somebody in the milk aisle that I had a task force for that, I think that would be doing a very poor job, so I appreciate it. If I saw somebody in the grocery store, what I would say to them is that we cannot have a very significant effect on particular prices. The price of oil in the markets today, or even the price of a dozen eggs, that does not have first-order consequences to what we're doing. But we do have a really important job there, and it's to make sure that those changes in oil or beef or eggs or milk don't broaden in the economy, don't have second and third order effects. That's our job, that's our commitment, that's our capability, and we're going to deliver on it.
Regarding productivity and jobs, Kevin said that AI will have a huge impact on productivity and employment, but he thinks that it will help the U.S. economy in the long run. And then he said that he has a task force that's going to look into it. I believe he's referring to the Productivity and Jobs Report task force. One question he was asked was that, are you trying to totally revamp the way Fed collects and analyzes inflation data? And like I did previously in this video, that a lot of critics are saying that that's what he's really trying to do behind the scenes. Instead of fixing inflation, just change how you report inflation figures. So let's see how he answered that question.
It sounded like on the task force on data that you were looking at overhauling or completely overhauling the system of national accounts, the way the government minds the economy. Is that your ambition?
In a word, no. In a few words, much of this data gathering happens in other government agencies to which we owe a tremendous amount of respect, tremendous amount of deference. But if in the course of this we come up with recommendations, which Fed staff have already begun to develop, about things that they could be doing to help inform us as policymakers, we're not going to hesitate. Again, I don't want to try to delineate the four corners of the research of the task force on data, but I do think there will be a review of official statistics, and at least as important, a view of bringing the best practices from the private sector and new analytical tools made possible by AI, so we can forge these into a fabric that gives us better real-time information. So as I mentioned before, when we're making decisions that we'd say are real contemporaneous data, not data that we call contemporaneous, that's really an echo of history.
Okay.
So as of today, until the next Fed meeting in July, the Fed Watch tool shows a probability of 63% of interest rates remaining unchanged at the next Fed meeting as well. A lot can change between now and then, so stay tuned. Please like, share, subscribe. Once again, this is Basir Perzada, your real estate broker and your mortgage loan broker, all in one-stop shop. We'll continue to bring you more relevant financial data as it becomes available. Thank you for watching.